Before we begin, make sure to subscribe to the channel and join our Telegram group where we discuss stock market insights, investment strategies, and answer your questions. The link is in the description. A company that isn't growing is slowly dying, but growth without profitability is just a money burning machine. The best companies strike a balance between consistent profits and sustainable growth. A business might have skyrocketing sales, but if it isn't turning that into actual profits, it is just running on hype. On the other hand, a company with steady profits but no growth will eventually fall behind competitors. So, how do we measure both profitability and growth to find companies that can deliver long term returns? Today, we'll break down the key profitability and growth metrics, explain their real world meaning, and help you spot both high quality companies and red flags before making an investment. Profitability ensures survival. A company that does not make enough money cannot sustain itself in the long run. Growth ensures expansion. A company that is not expanding will eventually fall behind competitors. The best investments come from companies that are both profitable and growing, allowing them to generate cash, reinvest in their business, and create shareholder value. The first step is checking how efficiently a company generates profits from its revenue and capital. Net profit margin measures how much of a company's revenue is left after covering all expenses, including salaries, raw materials, and taxes, and so on. If a company earns 100 rupees in revenue and 10 rupee remains as profit, its net margin is 10%. A higher margin means that the company is efficient at controlling costs and also into turning sales into profit. A low margin means expenses are eating up revenue, making the business vulnerable. Margins also vary by industry. Software companies tend to have very high margins, whereas retail businesses operate on very thin margins. Return on equity or ROE tells us how efficiently a company generates profit using the money invested by shareholders. If two companies can earn the same profit but one has a higher ROE, it means that using invested money is being used more effectively by the second company. A ROE above 15% is usually a good sign, but a following ROE over time may indicate that the management is struggling to reinvest profits efficiently. Return on capital employed or ROCE measures how well a company uses both equity and borrowed capital to generate profits. A company with high ROCE is using its resources efficiently, but if ROCE is declining over time, it could mean that the company is becoming less effective at generating returns. A high ROE and ROCE together usually indicate a very well run company with strong financial discipline. Revenue growth is one of the first signs of a healthy company. If a company's revenue is growing year after year, it indicates that the demand for its products or services is rising. A flat or declining revenue trend, however, could mean that the company is losing market share or facing industry challenges. Earnings per share or EPS growth tells us where profits per share are improving. A company with rising EPS is successfully increasing its earnings power. But if revenue is flat and EPS is growing, it might be due to share buybacks rather than real business expansion. Free cash flow or FCF growth is a strong indicator of financial health. A company can report high profits on paper, but if it is not generating actual cash, then those profits don't mean much. When free cash flow is increasing, it signals that a company's earnings are translating into real cash that can be reinvested or used to pay dividends or to reduce debt. If free cash flow is declining despite profit growth, it could mean that the company is spending too much on expansion without generating enough cash flow. While high profitability and growth are good signs, not all growth is healthy. A company with high revenue growth but no profits might be burning through cash too fast. If ROE or ROCE are declining, management might not be using capital efficiently. When EPS is growing but revenue is flat, it could be a sign that the company is boosting EPS artificially by buying back shares instead of growing its business. Negative free cash flow combined with high debt is another major warning sign. It means that the company might be borrowing money just to stay afloat. The best stocks combine strong profitability with steady, sustainable growth. To evaluate a company properly, it is important to compare profitability metrics within the same industry since businesses in different sectors operate with different margin structures. Consistent revenues, EPS, and cash flow growth over multiple years is a good sign of a financially strong company. When a business maintains high ROE, strong margins, and steady growth, it usually means that the company is well managed and creating long-term value for investors. Now you know how to measure a company's profitability and growth potential using key financial ratios. But looking at numbers alone is not enough. In the next episode, we'll bring everything together and analyze real-world stocks using these concepts. If you find this useful, hit the like button, subscribe, and turn on notifications so that you don't miss the next video. Also, join our Telegram group where we continue these discussions and share valuable insights. The link is in the description. See you in the next one.